We're going to start. It's bad weather. Maybe it's a little bit of a light crowd this year. We started last year with a pop quiz to start the program. And the pop quiz is comparing two mortgages, $2 million. One of them, Bank A is offering a rate of 3.45%, and Bank B is offering a rate of 3.5%. Both are 10-year mortgages, both have 30-year amortizations. Because Bank A's rate is a little bit cheaper, their monthly payments are $56 less, which saves you $669 a year and $6,687 over the 10-year term. The question is, which is the better deal? And it's obviously a trick question. So if anyone has an answer, you can raise your hand. Oh, one person got it last year. Mr. Ken, do you know the answer? Better for the borrower. The lower rate. That makes sense, right? The answer is obviously Bank B, because when you understand that there are different ways that banks calculate interest, there's one way called 3360. Before computers, in order for banks to calculate interest on a mortgage, they just decided to consider a mortgage year to be 12 30-day months. So a mortgage year was 360 days because they didn't have computers to help you calculate the actual number of days. But now with computers, they screwed you out of those 5 or 6 extra days of interest. And that method of calculating interest is called actual 360, or 365 divided by 360. And so therefore, on the same loan, you're paying more interest and less principal because you're paying 5 to 6 days of interest per year. So when you factor in the way that banks calculate interest, you'll see that although the payments over the term are $6,687 cheaper, you're going to owe $8,027 more at the end of the term because your payments on the 3360, more of your payments went to pay down the principal. On the actual 360, less did. So you saved $6,600 in payments, but you lost $8,000 in balance at the end of the term. So it turns out that the higher rate, Bank B, saves you $1,339. We were giving away free pens to the winners, so maybe next year. Yes, sir. Yes.
How much of a differential do I have to have in my rates to make that up?
Okay, so it varies according to the rate. It's between 5 and 6 basis points today. Depending on the rate, the higher the rate, the bigger the differential, because you're paying even more interest and even less principal. But today it's about 5 or 6 basis points. So, well, we know it's more than 5. Okay, so he says that they should declare the number of days in big letters, and I'm here to tell you that there's no such thing as big letters in any mortgage. It's all very small letters. Okay? Right? Right. Okay, guys. So we handed out the books this year. So the object of this, the reason that you're here, is because we really want to try to educate you and give you as much information as we can in an hour to make you informed on how the financing of an underlying co-op works. The mortgage brokerage business is a very interesting business, and there's different types of brokers and there's different types of originators. The way Meridian works, because we're a volume shop, is the more information you have, the better we look. And you'll see why that's true. Let's go real quickly. We're now a 26-year-old company. We were started with 4 partners in a small shop in Borough Park, Brooklyn. I think I was the 8th broker hired. I'm here 21 years. We now have over 300 brokers in 7 different offices across the country, and we're now the largest brokerage for multifamily financing in the country, but we're going to get to that. Let's not get ahead of ourselves. Okay. We've gotten some very good, obviously with the volume that we do, very good notoriety in the press. Let's just go through. 2016 and 2015 were very similar years for us. We closed in 2016 3,300 commercial loans. We don't do residential loans. That's 63 loans every week, or 12 mortgage closings every day. The total that we financed last year was a little more than $35 billion, which is $136 million closed every business day. And we did that with 220 different banks. And that's really the key, is that when you come to Meridian, we have no allegiance to any bank. We are affiliated with a couple of different banks, but we have no allegiance to any bank to send any loan to any bank. And our feeling is that we have to provide the best deal, because if we don't, some other broker will. So in order for us to kind of control the playing field, we have to find out who has the best deal, which we know is not always just the best rate, but who has the best deal for every loan, whether it's a co-op, hotel, retail, construction. And that's really how we control the volume that we do. And by doing the volume that we do, we're able to go to new lenders and get them to do things that they otherwise wouldn't be able to do to someone who doesn't supply the volume that we do. We'll get into a little bit more of that later. On the co-op side, we closed a little more than $1 billion in underlying co-ops last year with 19 different banks. And again, that's really the key, is that when you come to Meridian for your underlying co-op loan, we have access to all the lenders that are playing in that field to show you really where the best deals are. Okay. When you look, we're going to look at a second at the historical 10-year T-bill. The 10-year T-bill is called the benchmark T-bill because the 10-year T-bill is really the one that most mortgage companies, most mortgage banks use to base their mortgage rates on. And so tracking the 10-year T-bill really has a direct correlation to mortgage rates. The impression, and I've been here 21 years, my first day, the owner of the company gave me about a dozen co-op leads and said, call these guys up and tell them you have 7.25% money, which at the time was groundbreaking news. Since then, for 21 years, we've been saying rates are historically low and you have to refinance before they go up. And of course, we know that rates have not really been going up too much. So the general impression that everyone has is that rates have been low for a long time. And we're going to see how that's not necessarily true, is that even though the general trend is down, there have been spikes that can affect your mortgage rate very significantly depending on the timing. This is the 10-year T-bill for as long as the Federal Reserve has been tracking it. It's 55 years. So we all know that it spiked in the 80s, and you see that it's been coming down pretty generally since then. Okay, I'm sorry about the text. It didn't translate to the computer here. If you take a look at each decade, because again, most of you are going to probably take a 10-year mortgage. So if you look at each decade, we're going to see that within every 10-year period, even the last 20 years when rates have been coming down, you'll see that within the 10-year period, there's been a huge differential between the high and the low rate in those 10 years. So, I mean, the 60s and 70s is fine, but if you go to the 90s, the three on the bottom, between 1990 and 99, okay, there was a 4.93% difference between the high and the low of the 10-year T-bill, which means if you refinanced in the 90s, you had to make sure you were on the right side of that trend. Between 2000 and 2010, which again was a period that we all in our heads think that rates were coming down, but the truth is you'll see that with the spikes and the dips, there was a 4.71% differential between the high and the low between 2000 and 2010. And again, it's most surprisingly, the current time, in the last 7 years, there's been a 3.75% delta. So even though rates have been historically low, you can imagine that there's been a co-op that refinanced in the last 7 years that had a rate that was 3.75% below another co-op that refinanced in the last 7 years. So keeping an eye on the trends, keeping an eye on the actual rates is very important, even if the overall trend of treasuries are coming down. Now, we just looked at 10-year segments. Let's look at 1-year segments. The last 5 years in the 10-year T-bill, in 2012, the 10-year T-bill was as high as 2.32% and as low as 1.47. That's an 85 basis point differential within 1 year. In 2013, the differential was 1.38% between the high of 2013 of the T-bill and the low. 2014, 1.14%, 2015, 87 basis points, and last year, 1.25%. So what the point of this is that nobody can predict treasuries. Okay, we're asked all the time to predict where rates are going to be, and I tell everyone the same thing. I'd rather tell you where the lottery numbers are going to be. It's more helpful. But at the end of the day, one of the things that we do know is really how to watch for windows of opportunity and how to make sure that you're borrowing your money from a bank that can put you in a position to lock your rate when you want to. And that's really one of the most important things that you need to really remember when you're refinancing your underlying co-op. Okay. After the crash in 2008, there were many lenders. Many lenders went out of business. Many lenders got out of the mortgage business because in 2000, after the crash, two things wound up happening, is that treasuries came down dramatically, but the risk involved in mortgages increased dramatically. So the way that the risk involved in making a mortgage is expressed is in the profit that the bank makes, and the way they express profit is they'll say, we base our rate on the 10-year T-bill. We want to make a profit over the yield on the 10-year T-bill. Before the crash, the cheapest 10-year deal we did was 58 basis points over the 10-year T-bill for a 10-year interest-only loan. It was a Fifth Avenue co-op. It was the lowest spread ever offered. And just to make you understand that, if a bank has money to invest, they have to make a return. They could buy treasury notes. There's no invoice that they have to send out. They don't have to worry about not getting their money back. They don't have to worry about late payments. They don't have to worry about a fire or anything that'll interrupt them getting their interest payments back, like you do on a mortgage. Or they could lend it for more money and take those additional risks and lend it on real estate. To only make an additional 58 basis points means that lending on real estate was a sure thing. There was very little risk because 58 basis points is not a lot of profit to build into making a mortgage versus taking a treasury. After the crash, the spreads went up to the 240s, 250s, which means you took the 10-year T-bill, you would have to add 2.25% to 2.5%. Instead of 58 basis points, the perception of risk increased, so the profit that the bank had to take that risk increased to 2. We're now back down to the low 100s on a 10-year T-bill. Freddie Mac today is about 107, 109 over. So there's been more stability in the market. So the 5 different types of lenders, the agency lenders, Fannie and Freddie, you all know who they are. The disaster of the crash was not in your type of mortgage, was not in a commercial loan. The problem with the crash was that the agency lenders lent money to homeowners who couldn't afford the mortgages. You probably all saw the movie. Commercial loans were spared really any of that default mess. It would have been much worse. Life insurance companies are very interesting. They're very effective today in offering long-term money, 15 to 30 years, and the life companies are making really creative loans today for co-ops. We've created co-op specific programs with 2 different life companies, and they've been very popular. They're swap lenders. Swap lenders and CMBS lenders are very similar in that they turn out, they'll go ahead and lend the money, then they'll pool a bunch of loans together and they'll sell them to investors. Mortgages, because they're safe, become bonds that a pension fund will buy, a Wall Street, a diversified portfolio account will buy, different investors will buy these mortgage-backed securities. And swap lending and CMBS are different ways of doing that. And the last is the portfolio lenders, which are your local savings banks, which will make 5, 7, and sometimes 10-year mortgages and keep them on their books. And the portfolio lenders have a lot of benefits that the other lenders don't, because they control the loan, they control the prepayment penalty. You can have different types of prepayment penalties that aren't as onerous as a loan that's being sold. Because imagine, if you're selling a loan to an investor, he's paying a certain amount today for this long-term annuity. If you're selling a loan to an investor, a 10-year loan, and the guy refinances 2 years later, the investor's out of money. What did he pay for? He paid for a 10-year return. He got a 2-year return, or got a 5-year return. So that's why prepayment penalties on a lot of the mortgages are yield maintenance or make-whole penalties, which we're going to get into in a minute. But on the portfolio side, because they hold on to the loan, their prepayment penalty, they're not selling them to anyone. Their prepayment penalties are a lot more kinder and gentler, and we'll get into that. Securitizing lenders, because they sell the loan and they have no emotional connection to it, securitizing lender doesn't care if he gives you a 10-year loan and then 6 months later the rates shoot up and they have now this low rate 10-year loan on their books. They sold it to somebody else's books. So the securitizing lenders can offer the lowest rates because there's no financial relationship with that loan after they make it. The prepayment penalties, the make-whole prepayment penalties are exactly that. If you're selling a loan, the guy who's buying it is expecting a certain return, and the prepayment penalty has to guarantee him that return, and we'll get into yield maintenance and how that works. The portfolio guys, you know, if you take a mortgage with a portfolio lender, you need more money, you want to refinance, their prepayment penalties are a little bit different. They're easier to refinance, and they will cut a prepayment penalty, negotiate a prepayment penalty if you stay with them. Portfolio lenders are typically a lot easier to work with. They're not the best rate, but they sometimes might be the best deal. The point is, you need to know all this, right? You need to know that there's a huge market and that you have to make sure when you're refinancing that you're seeing the best loans from the right lenders. The reason that we can do $1 billion a year of underlying co-op loans is because, again, I told you, knowledge is key. The education is key. And the more you guys understand about the loans, the greater the chance you'll take the right loan for your co-op. And that's really, we don't get beat in terms of rate, we don't get beat in terms of terms and conditions. We created a large part of this market, and that's why you know, we really try and educate people as much as possible. I told you there's the 5 different types of lenders. All together, they offer any combination of rate and amortization that you could possibly want. Anything from a 5-year self-liquidating loan to a 30-year interest-only loan are available today. The market is just really unbelievable for co-ops. So again, when it comes time to taking a look at your loan, there's a lot of things involved. If a co-op is borrowing a lot of new money, for example, if you're borrowing and you're significantly increasing your mortgage, taking a 10-year deal is tricky because 10 years goes by very quickly, rates are low, you're increasing your mortgage. 10 years from now, if rates are higher, you're going to be hit with a huge debt service increase. So co-ops that are increasing their mortgage significantly, we might ask them to take a look at 15, 20, or 25-year loans just to give them debt service stability, and you don't have to worry about that time bomb going off. Because you know, at the end of the day, you're competing with co-ops in your area. So someone looking to buy a unit in your co-op is going to compare your financial statement to the co-op across the street. If you have a great 10-year loan that's got 7 years left and rates are up, the prospective buyer knows, well, look, we got a great thing, but in 7 years, we're going to get a hit on the maintenance. If the co-op across the street has a good loan, but he's got a 15 or 20-year term, obviously there's more stability. That translates into a higher value for your units that you're selling. Okay. There's basically two types of prepayment penalties. There's the fixed rate sliding scale penalty, which it's called 554-433-2211 or 333-222-1110. Those are the two most popular. And what it means is these are the portfolio banks that I told you can offer a little more creative type of prepayment penalty. Every co-op loan, underlying co-op loan, every commercial loan has prepayment penalties unless you have a ridiculously high rate, which is in itself your penalty. So the most, I guess the most comfortable prepayment penalty is a fixed rate penalty where you know what it is at all time. On the 5544, if you want to refinance in the first 2 years, your penalty is a fixed 5% of your outstanding balance. 4% the next 2, 3, 2, the last 2 years 1%. The other lenders, which are a little more common today, 3% the first 3 years, 2% the next 3, 1%, and no penalty the entire last year of the loan. These are very popular. The only reason you wouldn't take such a loan is if the rate on the other loans, on the yield maintenance loans, are that much lower. As we said, the securitizing lenders that offer the lowest rate, Fannie Freddie, the CMBS, the swap lenders, they have to guarantee the investor the yield for the 10 years. That's what we call maintaining the yield or yield maintenance. And let's go through yield maintenance. It's important for you. It's not difficult. It's a little bit of math, but it's not difficult. Hate it when it doesn't line up. Let's take a $2 million loan with a 6% rate, interest only, that started in April of 2009, maturing April of 2019 with 2 years left, 24 months. The annual payment is $120,000. If you have such a loan, $2 million, 6%, and you go to the bank and say, we need to refinance, the bank says, okay, we're going to take the money you're paying us back, and we're going to buy a 2-year T-bill because we promised our investor a 10-year return. We're going to buy a 2-year T-bill because that has the matching maturity, and if the yield on the 2-year T-bill is 6%, which is what you're paying me, then we're fine. Then you just have to pay me the 1% minimum penalty. But if the rate on the 2-year T-bill is less than the mortgage rate, you have to make up the difference. You have to maintain the yield. So let's see how this works. Let's assume the mortgage rate is 6%. Let's assume, just for ease of math, the 2-year T-bill is 4%. The 2-year T-bill today is under 2%. Is it under 1%? It might actually be. But let's assume, let's just for math purposes say that the yield on the 2-year T-bill is 4%. So you have 2 years left, and there's a 2% difference between the yield on the T-bill and the rate that you're paying. So your penalty becomes 2% per year for the 2 remaining years. So your penalty in this case would be 4% of the loan amount. Okay? This is important. Are we all okay with that? Okay. Let's say we refinance that loan today paying 6% to a new loan paying 3.8%. That would lower the mortgage payments from $120,000 to $76,000 per year, saving the co-op $44,000 a year, $440,000 over the term. The 4% penalty on the $2 million balance is $80,000. So it's going to take you less than 2 years to recover the penalty with the new 3.8% rate. Or if you wanted to keep your payments at $120,000, you could increase your loan amount to $3,157,000. You could borrow an additional $1,157,000 and keep your payments the same. That's another way of monetizing the savings in rate, is borrowing more money at no additional cost. Those are your two options. But that really explains how yield maintenance works, why you had a yield maintenance penalty. You were either brought, for any of you today with a yield maintenance penalty on a 10-year loan, well, I'm not going to say it. I was going to say you went to the wrong broker, but the truth is we did several yield maintenance deals when rates were favorable for those products, but you always have to see your options. That's the bottom line. Oh, and by the way, yield maintenance by itself is not a problem. If a lot of you are familiar with the history of your refinancing, a lot of you probably were burned by yield maintenance penalties in the past. Yield maintenance by itself is not the problem. Yield maintenance with a high rate is the problem. You take a loan today with yield maintenance and a 3.8% rate, the 10-year prospect is that rates are going to slowly migrate up, and if they do, your yield maintenance, the yield on the treasury, on the corresponding treasury, is going to go up, so your penalty is not going to be as bad. The problem with yield maintenance in the past, the rates were in the 5 to 6% range, and then the floor dropped out. Defeasance is a form of yield maintenance. Now, we said the bank tells you if you refinance your loan, they're going to buy a 2-year T-bill or a 3-year T-bill, however many years are left. They don't really buy the T-bill. They just say they do. What they really do with the money is they lend it out to the next guy at 150 over, or whatever the spread is at the time. In a defeasance loan, they really do buy the T-bills, and they actually replace the collateral of the loan from the co-op, from the building, to treasuries. So they actually do purchase the treasuries, they replace it, and so the yield, they calculate the yield maintenance penalty, then they buy the treasuries, and the cost to buy the treasuries and to record them as the collateral is expensive. It's about $60,000 to $80,000 to administrate the defeasance of a loan, to swap it out. So defeasance is a killer, especially on a small loan. On a small loan, the $60,000 to $80,000 is a huge percentage of the penalty. It's a huge amount. If your mortgage is $6 or $7 million or more, a $60,000 defeasance cost is only about 1%. It only adds 1% to your penalty. Now, why would you even consider a defeasance loan? Because the interesting thing about defeasance is that if, when you refinance the loan, if the yield on the treasuries is more than the rate you were paying, then the bank's going to make a profit, right? He's going to make more money when you refinance and buy the treasuries because the treasuries are yielding more than your mortgage. That profit that he makes gets calculated and deducted from the balance that you owe. So you make the profit on a defeasance loan. You would only consider defeasance loans if the rates are that much better and if your mortgage is $6-7 million or more. Anyway, so that's a little bit about defeasance. And we just answered the question, why would you consider a defeasance penalty? So the question is, has it ever happened in the history of mortgages? Has it ever happened, well, in the last 30 years, has it ever happened that the defeasance, that the yield on the corresponding treasury was more than the mortgage rate? Never happened. It's never happened. If you go back to that first graph of the 55 years and you take a 10-year slider, you will see that the rates in any 10-year period were higher at the beginning than they were at the end. So that means that the rates when you refinance a loan over the last 30 years were never higher than when you took the loan out. So the question here is, let's say you can take a defeasance loan today at 3.4%, because that's the yield on an agency loan for 10 years. You could get rates as low as 3.4%. So the question is, looking at the 2-year T-bill, has the 2-year T-bill been 3.4% in the last 10 years? And the answer is yes. 8 3/4 years ago, in July of 2008, was the last time the yield of the 2-year T-bill was 3.4%, which means if it goes back there, you'll have no defeasance penalty. You'll have no yield maintenance penalty. And if it's higher than 3.4, you'll make a little money. Again, these are very important things to know when you consider such a loan. Okay, how do we take advantage of today's rates? Most co-ops today, in any given time, are more worried about having to borrow additional money than lowering their maintenance. I mean, the luxury of a co-op being able to refinance, cut their penalty, not need any more money, it's a little rare. It happens, but it's rare. So the question is, if you have a rate that's in the high fours, low fives, mid fives, and you want to refinance today, what you could take a low rate for 10 years, you had a low rate for 10 years, and then the party's over. How do we optimize the rates today for a longer period of time? How do we take advantage of it? And it's not just taking longer term loans. Many more co-ops today are interest only than they were in the past. But one of the ways that we try to show you guys, okay, let's go over, this is very important. Interest only loans on co-ops, there are still some traditionalists, which is another word for old timers, me being one of them, who will cringe and then scream at anyone suggesting they take an interest-only loan, because most co-op board members, most of them, want to have no mortgage. And at the end of the day, when you're running a co-op, if you take the top 10 responsibilities of a co-op board, being mortgage-free is not on those top 10. Maintaining the building and all the things that go involved in maintaining the building are your primary responsibility, because you need to maintain the resale value of your units, your lobbies, your roof, your boilers, your windows, your elevators. I mean, all the contracts, the gas, the heat, everything that goes into running the co-op, those are the things you need to optimize. Being mortgage-free, believe me, should not get in the way of any of that. So one of the things that we explain to people who maybe have to take an interest-only loan or are considering it is that there is an amortization effect to real estate. There is a self-amortizing effect to real estate. So we'll explain how that works. Over any 10-year period, two things have happened historically. The value of the dollar has gone down, and the value of the real estate has gone up. So if you take the same $2 million, $10 million, $50 million mortgage from 10 years ago to today, that value of the money has gone down, the real estate's gone up, so your leverage has gone down. So you are less leveraged than you were 10 years before. That's even if you have a yield maintenance penalty and the dollars stay the same. To show you what this means, $2 million borrowed in 2007, interest only, would have a value in today's dollars of $1,671,000. Over those 10 years, the value of the money you borrowed went down by $328,000. That makes borrowing money a bargain. I mean, it really does. The value of the co-ops over that period has gone crazy. In fact, did I quote the thing? Yeah. There's an analysis, and it's in the book, the web page. There's a Douglas Elliman report on co-op sales in Manhattan over the last 10 years, and it shows that Manhattan sales prices are up 41%. So the value of your money went down about 16%. The value of the money went down 16% over 10 years. It's about 1.6% per year of inflation. And the value of the real estate went up 41%. So that's the amortization effect of financing real estate in New York. So this is the report. You're probably not going to be able to see it, but oh. All right, if you come to us, the URL didn't print. You can search in the Douglas Elliman site. They have all the reports online. This is 2006 to 2015 Manhattan co-ops and condos, and it tracks prices, sales prices, and lease prices. So it really is, it's very helpful. Again, you have to approach financing your co-op a little more sophisticated than, I don't want to have a mortgage, I want to be mortgage free. It's not usually going to work. In order to take full advantage, one of the ways you could do it is by taking a longer term mortgage, locking in today's rates for a longer period. One of the most amazing things that's happening today, when I started 21 years ago, one of the most popular mortgages, and you guys might be familiar with this, was the 15-year self-liquidating. You remember, you always had a friend that took a 15-year self-liquidating loan, and he bragged about how little interest he actually paid. And the way we used to understand this is that, let's say you borrowed $100,000, 15 years self-liquidating, you wound up paying $170,000 over the term. You didn't even pay twice the interest that you borrowed. With a 30-year self-liquidating loan, you borrowed $100,000. You wound up paying about $220,000 over 30 years. So you're doubling what you borrowed in interest at the higher rates. Today, it's the opposite. Well, not the opposite, but today, a 30-year self-liquidating loan, you're paying, here, let's take a look. On a 30-year self-liquidating loan, you're not even, your total payments over the 30 years are not even twice the mortgage amount. So you're paying off your mortgage, your interest is less than the actual money that you borrowed, so you're taking somebody else's money for 30 years, and the actual cost is the cheapest it's ever been. Okay. So let's assume you're not going to take a 30-year self-liquidating loan. How do we take advantage of amortization to help us benefit from today's rates for more than 10 years? So one of the things that we show in this presentation is how to accelerate your amortization. And for example, if you have an interest-only loan today that the rate is 4.86% or higher, you can take a new mortgage at 3.8% and go on a 40-year amortization and start paying down your principal. This is a way to take advantage of today's rates, and so that at the end of 10 years you actually do owe a little less money, so that if in 10 years you owe less money because you paid principal, rates can be higher and you won't feel it. You can go back to the interest-only loan then, right? You have some buffer to play with. At the end of a 10-year $1 million loan, would have a balance of $870,000 after 10 years on a 40-year amortization, so you're amortizing about 13% of the balance. So that $130,000 that you don't owe anymore, again, you're only going to refinance $870,000, so rates could be a little bit higher, and your shareholders won't feel it as dramatically as they otherwise would. If you have a 40-year amortization today, and your rate is 4 3/4, you could take a 3.8% loan on a 30-year amortization. And again, you would wind up accelerating the pay down of what you owe. If you have a 30-year amortization, if your loan today is on a 30-year amortization and your rate is 4.67, you could take a 3.8% loan today on a 25-year. So again, these are ways of benefiting from today's rates for more than just the next 10 years. It's for really setting yourself up to have a lower mortgage in the future. Come on. All right. Did it print right? Go to the next one.
It all printed correct.
Okay. In the book, it's nice. It's just on the computer. This is a quick table. If you're interest only with a 4.86% rate, you can go to a 40-year amortization. If you have a 40-year amortization with a 4 3/4, you can go to a 30. Right? So you understand how this works. It's just one method of, again, taking advantage of today's rates. Before 5 years ago, the only source of a 30-year self-liquidating mortgage for co-ops was Fannie and Freddie, or NCB, which securitizes to Fannie and Freddie. Fannie and Freddie 30-year self-liquidating loans for co-ops were problematic because Fannie and Freddie did not offer reliable subordinate financing. It means when you took the loan out, you couldn't reliably expect to be able to refinance more money because A, you had to go back to Fannie Freddie. It was subject to their pricing and availability at the time you go. Their underwriting criteria is constantly evolving, which means that if your loan to value at the time you took the mortgage allowed you for more financing, it could be that the LTV requirements change in the interim and the new regulations don't allow you to take more money. So the bottom line is co-ops who had the best interest wanted a 30-year self-liquidating. They thought they'd be mortgage-free. They wind up refinancing after 7, 8, or 10, or 12 years, paying huge penalties, huge. So we never, ever, ever advocated for a 30-year self-liquidating loan because it didn't make sense for co-ops. Guys, you're always going to need money. In 30 years, everything's going to go in the co-op, and sometimes personally. So at the end of the day, you always need access to additional money. What we did in 2011, I believe, for the for the Lincoln Towers buildings here on West End Avenue is we went to a life company and said, we need a 30-year loan, but we need certain co-op specific features. The most important is we need to be able to go back multiple times during the 30 years for additional money. It has to be written into the loan. So we ultimately got one of our life companies to give us the ability for a co-op to go back to them 5 times in 30 years. That's an average of every 6 years. That's better than a 10-year tract. Not only could you go back to them for the additional money, it's called additional money. And the reason it's called additional money, it's not subordinate. They blend the additional financings into the first mortgage, which is very good for you because if they stop giving the money and you need to go to another bank, they allow you to go to any bank you want to get subordinate financing, which is a second or third mortgage. So if you have your operating account somewhere, if you have your business account somewhere, and you go to them and say, look, I need $1 million subordinate to be the second position, we're only 15 or 20% loan to value, it's a safe loan, you can get a mortgage from any bank you choose. And even better, the subordinate money that you can get from other banks doesn't even have to be coterminous, because very few banks are going to give you a 22-year mortgage or 25-year mortgage or 20-year mortgage. So you could go to another bank and take a 5-year mortgage or 7-year mortgage, knowing that at the end of 5 or 7 years, when you have to refinance your second mortgage, you're probably going to need more money then. So you have no prepayment penalty, roll that into a new mortgage, and you kept your big underlying mortgage safe in the low-rate 30-year term to be self-liquidated. That was what we needed, and that was what we used, and we've done probably about $1 billion of that business in the last 5 years. We don't like it because we like to do short-term mortgages, 5 years, refinance you after 3, but of course that's not the best interest of the co-op. So the 30-year terms are great, for the co-op. We enjoy it. As long as it's the right loan and the right fit. Okay, and that's it. Wow. Yeah. Okay. Any questions? Oh, hold on. We have a microphone in front of you. Want to give him? He has the microphone. Oh, there. Okay.
It's like Phil Donahue.
Yes.
Hi, I just had a question.
Sure.
I'm just trying to figure out what do you mean by self-liquidating loan? I'm not familiar with that terminology.
Self-liquidating mortgage?
Yeah.
It means you take a loan that has let's say a 15-year self-liquidating means it's a 15-year term with a 15-year amortization, meaning at the end of 15 years, you've paid back the whole mortgage. You have no balance at the end of the 15 years. It's completely paid off. 30 years self-liquidating means it's paid off over 30 years. Most homeowners, condo owners, co-op owners take a 30-year self-liquidating loan. If you borrowed on your unit, it's either 15 or 30 years is the most common. It means you have no. Now, your real question that you're probably asking is, what does it mean a 10-year? When you take a 10-year loan today on a 30-year amortization, it means that you have to refinance that loan after 10 years. So it's called a balloon mortgage. So
Or a balloon note, right?
the balloon mortgage
Yeah.
means that you'll have at the end of the term of your mortgage, there's an amount of money that you owe. It's the balloon. That's the amount that you still owe. You have to then refinance that with a new loan. Okay? Anyone else? Wait 1 second. There you go.
On the co-op loans,
Yes.
example, financing a mortgage. Now, how do you judge the outstanding? Who comes first? The bank that finances the individual co-ops, or you, the other bank that finances the whole mortgage?
What are we talking?
Who comes first?
So generally speaking, people who are doing the individual loans are not doing the whole building. So when you say who comes first, you mean as the lien
Just in case of,
in the event of a foreclosure?
the individual banks that finances the individual co-ops, which we don't know.
Right?
He's asking in the event of a default, you have an underlying mortgage on the building, and the shareholders have individual loans on their units. So in the event of a default,
Who gets paid first?
who gets paid first, it's always going to be the underlying mortgage, because the underlying mortgage is on the building itself. It's on the land and the building.
Right.
Your share loans, the loans on your units, are really business loans. They're shares of a corporation. If the corporation is dissolved, they come after you personally. So if the co-op goes bankrupt, the underlying mortgage, the bank that has the mortgage on the building, they have the building. They don't come after you. They don't come after the shareholders, because they can sell the building. The shareholder, right, they can take over the building. You're not a co-op anymore. Now you're an apartment building. So they're going to rent the building, and the rent will pay the mortgage until they can sell it. But in a default, your residential shares, they come after you personally.
Oh, wow.
But that's not me.
Most of the banks, they don't do that.
That's not us.
So if he go bankrupt, the whole co-op, everything, the banks. Yeah.
The co-op, underlying co-op loans are always non-recourse. They're always not. There's no human being responsible for it. You know this guy. How you doing?
Hey, Steve, how are you?
Good.
In the subordinate financing you were talking about, where we have a first 30-year fixed and a low rate with
Right.
life insurance, you have subordinate financing. Is there any type of cross-default language in that second loan where some sort of technical default would trigger a default on the first?
There's an intercreditor agreement that allows both loans to exist on the same title.
Oftentimes, yes. A lot of lenders will try to cross-default them.
So if there's so then the second loan would need to be like a covenant light loan, because there could be a covenant violation on the second loan that could trigger problems with the first loan?
It really depends on the lender, honestly, and if there's any relationship or, as Steve mentioned, any intercreditor agreement between the two.
Talk into, yeah.
It does depend on the lenders, both on the first and on the additional
There you go.
pieces.
Yeah, we have a loan, a balloon, and at the end of the term, there's a refinance option. The terms of the refinance options are, quote, at the bank's cost of borrowing funds. What does that mean? The bank could
say it one
answer
more
for
time.
me. The bank's cost of borrowing funds. It's
What?
2 or 3 points above the bank's cost of borrowing funds.
Okay, that's a very interesting question. The bank's cost. The bank's cost of funds is part of the spread that you're paying over the Treasury. It's part of the additional rate over the Treasuries. It's not the whole amount. The cost of funds is a piece of your mortgage rate. The rest is the profit that they want to make. So the bank's internal cost of funds is not based on Treasuries. To my understanding, it's more based on the LIBOR, the overnight rates, right? That banks kind of trade with. So you don't really have to worry about the bank's internal cost of funds, because as long as your rate is favorable, you're going to compare rates, terms, and conditions. Worrying about a bank's internal cost of funds, you're not going to negotiate with them. There are times when a bank will lower their rate to compete on a loan in order to win a loan. But you don't have to, as a borrower, never have to worry about a bank's internal cost of funds.
Except in this option, it sounds like they have a
Well,
reprice.
we do, though, at this point. If we're going to take the refi option,
It's interesting.
I mean, obviously, at some point, we have to know it. I guess you're saying we don't have to know it until it's time to negotiate.
Well, the lender would have to tell you, because unfortunately, they're
Your
determining.
penalty is
their
based
internal-
on the bank's internal cost of funds? Is it
No,
a
not
J-
the penalty, the refi.
or if reprice or refi.
Is it
or
who's your
renewal.
The
who's
new
your
loan.
bank?
Dime.
Dime in New York.
Right.
So it's a
That's
swap.
usually
It's a swap.
FHLB.
Not a swap.
The renewal's usually.
Let us take a look. No, seriously, we'll let us take a look. Now, guys, one thing, very, very, very important. There's a very, very big misunderstanding out there, and it's almost criminal. There's a big misunderstanding that if you have a penalty, you cannot refinance. Uninformed management companies will tell you, you can't refinance, your penalty's too high. That's not the case. We saw an example where you had an $80,000 penalty, but the rate differential allowed you to recover that in a couple of years. So the prepayment penalties, yield maintenance penalties, they can be onerous, but they still could be recoverable, and the economics could absolutely still be there for you to consider refinancing, paying a penalty, and taking advantage of low rates. another quick, very important thing, all prepayment penalties are tax deductible to different amounts. There's a guideline, you got to talk to your accountant. You can't deduct more than the interest that you pay annually, but there is a portion of the prepayment penalty that is tax deductible, which mitigates the penalty even further. And when we say tax deductible, it's prepaid interest, so at the end of the year, your individual shareholders have a big interest deduction for that year that you paid the penalty. Don't let a prepayment penalty stop you from looking into refinancing, because part of our analysis, a big part of our analysis, is showing you how long it would take to recover the penalty, how much you could borrow with the penalty, keeping your payments the same. Don't ever let that, in fact, with him, don't ever let that stop you from getting an analysis of what a refinance would look like.
And one other thing I want to add to Steve's
Yeah.
point, if you're
Oh,
not,
I'm sorry.
if you're not sure what your penalty is, you can always reach out to us and we'd be happy to calculate
Right.
it for you. You don't have to pay us just for that. We're here to show you the numbers, tell you what it looks like, and then from there you can make some informed decisions.
Right. Yes, sir.
Steve,
Yes, sir.
in the type of loan that allowed for subordination of other loans, like you did in the Lincoln Towers, have you had much success with that outside of Manhattan?
Oh, yeah, no. The 5 boroughs, anywhere up here we can get you the life companies. Again, life company loans have to be about $8 million or more.
I see.
They do a little bit of a larger loan. No, that we can, any loan in this tri-state.
And those type of loans encapsulate certain capital improvements that are going to be needed over a fixed period of time, such as 6 years, new roof, or something along those lines. So it's sort of built into the loan that you can go back more easily to in order to obtain
Right.
financing for that.
Well, again, one of the parts of our analysis is if it's a 10-year, 15, or 20-year term, is we're going to look at when are your windows going to need to be redone? When is the boiler, the elevators, the roof? You know, all the big-ticket items we like to really try to take a look at and make sure that we're covering it. I got to tell you, I'm not going to be specific, but we did a couple of these 30-year loans. We have one, it was an $18 million loan. They're coming back to us now for $12 million 3 years later. And they're getting it. I mean, the system, thank God, works. The point is, when you don't plan ahead and you don't really look at the lifespan of the big-ticket items, you don't want to get caught like that. And by the way, when we call it additional money with the life companies, what does that mean? Because they blend it into the first mortgage, the pricing for that additional money is first mortgage pricing. It's their best pricing. And on this particular case, 2 of the buildings, the neighboring buildings, they're getting second mortgages where the rates are lower than the first, because it happens to be rates are lower now. So the system works beautifully. Rami up here.
Hi. So what if you have a capital improvement that has to be scheduled and done like now, and it'll take time to refinance? Can you borrow from a shareholder?
Well, you assess. That's called assessing.
We can't do an assessment because we're just not rich enough for all our people
Oh.
to put up money. But we have one shareholder who said, I can afford it. Can you borrow from me until you can get the refinancing?
Talk to your lawyer and you got to look at the bylaws. You got to talk to your lawyer. That's not a question for me. I'd rather you borrow it from us.
And I think it depends if you have a loan, if there's something in your existing loan documents that may restrict something like that. Your lawyer's the best bet.
Yeah. It's the hustler. Yes, ma'am. That's not we covered that. I don't have any predictions. Look, the only thing that based on my understanding of the market, we are at a precipice where if the health care bill gets adjusted or changed, where the mandate gets removed and the pressure on businesses gets removed, and tax reform happens where the corporate tax rate goes down, my understanding is that the economy is going to take off. And a strong economy brings with it higher rates. So I've been wrong in every prediction I've made for 21 years. And like I told you, I'd rather tell you what the lottery numbers are going to be tomorrow. But at the end of the day, you can only just kind of try to take your understanding of economics and apply it to today. Rates are low today. Borrowing money today is a sure thing because you're guaranteed to get a low rate. Can rates go down a little bit? Sure. But there's a greater chance that they're going to go up because there's more room to go up. So that's really how we assess what you should or shouldn't do. Yes, sir.
Freddie Mac and whatever this government agency.
Yeah. No, they'll do little deals. Fannie Mae will do $500,000 loans. I wouldn't do it with Fannie Mae because their closing costs are very expensive. We could do better, but no, Fannie Mae does. No, Fannie Freddie does any size loan over $500,000. Yeah.
Just a general question. Are you suggesting that a 10-year loan on a 30-year amortization schedule, meaning that there's a balloon payment at the end, is less desirable than a 15 or 20-year loan with a 30-year amortization?
Most co-ops really should take a 10-year loan to keep them nimble enough to address future capital needs. Not all co-ops.
Comparing your co-op or condo for the Internet of Things.
No, the 10-year loan makes the most sense. Certain co-ops that really are tightly run, really, that have a good handle on what their needs are, what their future needs are, and we can come up with a plan to address those needs, then they can consider a 30-year loan. We don't recommend anything. We don't, because it's a business decision. All we can show you is our spreadsheets now have evolved, and literally most of the deals when we go into a co-op meeting, most of them involve between 8 and 12 different options. I mean, it's an amazing thing. That's how we do it, and then we try to whittle down what's the best interest of the co-op. What are they? So no, we don't suggest a 30-year loan.
The reason I ask is that our prior board in 2014 refinanced and went from about a 7% plus loan down to 3.88
right.
for 10 years, paid off the existing mortgage, but in the new mortgage, borrowed another $700,000 and got a $500,000 credit line.
Credit line.
Which, as you say, just sort of merges into the overall mortgage at the end of the 10 years.
When you borrow it. Which bank did you go to?
I think it was NCCB or something like that.
Okay. Yeah, that.
This was the prior board.
Yeah. No,
and I just
look,
happened to read the agreement yesterday, and I was just a little curious.
NCB is the only bank that doesn't work with us, and we understand why. I'll just put it to you this way. We lose no business to them on a head-to-head basis when you compare everything. Yeah, all of our loans, 10 to 15-year loans, most of the 50, all of them have credit lines that come with the loan. Credit lines, we should put it in the thing. You're going to want to get a credit line. You're going to want to get an unsecured credit line. But you got to be very careful with credit lines. And the way credit lines are credit cards. And the way we recommend to co-ops that you use a credit line is a way of stretching out an assessment. Don't put a capital improvement job on a credit line and leave the balance there, because all credit lines are adjustable rate. The rates are going to change. If rates start moving up, your debt service goes up. You don't want to leave a large balance on a credit line. Instead of assessing over 18 months, you could assess over 36 months because you have it on the credit line and you can just pay it down. That's the best way to use the line of credit.
Well, the board, this was the prior board, I should say, went a little crazy, and in 2015 we had 4 major projects resulting in 2 assessments, borrowing $300,000 out of the $500,000 on the credit line. I don't know what happened with the extra $700,000 from the 2014 financing. So, and we have a couple of, within a few years we have some major projects
Come visit us at the booth.
Elevators and roof.
Yeah.
So.
Okay. Anybody else? Okay. Thank you very much, guys.